In this video, we will discuss about the beginning of money and banking. Let's start. Barter economy. We will start from the barter age. So, exchange of surplus between parties could be referred to a barter system in simple, right? So, the solution taken by people to overcome the lapses they faced in barter system is money. Money is any item that is generally acceptable in exchange for goods and services. Economists define it as something that serves as a medium of exchange, a unit of accounting, and a store of value. Qualities of money, those are general acceptability. Everyone can accept. Everyone will accept money. Durability, profitability, divisibility, limited in supply, stability, and homogeneous or identical. Types of money. Types of money are cash, currency, or legal tender. Money in current account or bank money, near money, money substitutes, e-cash, digicash, e-wallet, or electronic cash purse, cash money, token money, black money. So functions of money are primary and secondary. So function of money is medium of exchange. It acts as a medium of exchange also, and it can be measured in value. So the secondary function of money is like we can store the money. Standard of deferred payment. Functions of money are as a unit of account or measure of value. The primary function is money acts as a measure of value, and it can be used to compare the value of goods and services and factor rewards. Facilities efficient allocation of limited resources. It helps to measure the price level and changes of them. Facilities accounting calculations helps to set prices for products. The secondary function of money includes is this means holding wealth in the form of money for future transaction and investment purposes. Thus, money links present and future through this function. It promotes saving, investment increases, production gets expanded due to increase in investments, accelerate economic growth due to increase in production. In times of inflation, this function of money is distorted and opportunity cost is involved here. Function of money as a standard for deferred payment. So money enables people to borrow and lend agreed amount. Easier and convenient way of measuring debt and repaying debt. This function links present and future, facilitates the growth of trade, stimulates the growth of money market. It also acts as a medium of exchange. So this facilitates trade. It removes the problem of double coincidence of bonds. It facilitates modern production aspects like division of labor, specialization, etc. The value of money. There are two types of value of money. First one is official value, and the second one is real value. So within the real value, there are two values more, like the internal value and the external value. The official value can be defined as this is the value indicated on the face of notes and coins. This is imputed by the government. Let's say $1 bill is actually $1. That is the official value of that $1. What is the real value of that $1? So this is the amount of goods and services that can be bought within the given amount of money or per unit of money. The real value highly depends on the general price level of goods and services. So what are the internal and external value? So internal value is domestic value. This is the quantity of goods and services that can be bought with the particular unit of currency within a country. This depends on the general price levels in a country. That is when the domestic price level falls, internal value of money rises. So what is the external value of money and also foreign value of money? This is the rate at which one currency is exchanged to another. In other words, it is the exchange rate between two countries. Liquidity. So liquidity refers to the ease in which an asset can be converted into cash without delay at little or no cost. Liquidity describes the degree to which an asset or security can be quickly bought or sold in the market without affecting the asset's price. Demand for money. Demand for active money balance. This is the sum of transaction demand for money and precautionary demand for money. The major determinant of active money is of money balance is income. Assets according to the range of liquidity. So cash can be considered a liquid asset. Demand deposit, time and saving deposit, money substitutes, financial and physical assets. Reason why people keep wealth in the form of money rather than other forms. Money is the perfect liquid. It is easy to store and portable. Uncertainty in the market value of no monetary assets. Demand for money. So John Maynard Keynes distinguished three different reasons people to hold money instead of alternate assets. Transaction demand for money and precautionary demand for money, speculative demand for money. So demand for money can be identified as the amount of money that people want to keep to meet their regular or day-to-day expense. Day-to-day transactions could be simply known as transaction demand for money. Factors determining the demand for money. So income, time interval, general price level, financial innovations, etc. Uh, Supply of money. So money supply is the amount of currency in circulation at a given time. In other words, it is the stock of liquid assets held by a general public of an economy. The operating target of money supply is reserve money, whereas the intermediate target is broad money. So the final target is the meant to be the price stability of the economy. So classification of money supply. First one is currency outstanding, currency held by public and currency with commercial banks. Commercial banks deposit with the central bank. Government agencies deposit with the central bank. So reserve money is first, second plus third. Then there is demand deposit held by the public with commercial banks. Narrow money supply, time and savings deposit held by the public with commercial bank. Then there is broad money supply. Then there is foreign currency deposit. Then the next one is consolidated broad money supply, deposits with licensed specialized bank and finance companies, extremely broad money supply, right? Reverse money or high powered money or base money. So these are site liabilities of central bank and are created and injected to the economy by CBSL and serve as the operating target of monetary policy. The base money provides the basis for the country's money supply. So multiplier. What is money multiplier? So the money multiplier is the ratio between base money and money supply. Money multiplier equals to money supply divided by the base money. So relationship between reserve money and money multiplier is actually money supply equals to money multiplier into monetary base. So this is the relationship between the reserve money and the money multiplier. So let's go back to the factors determining the MDP. So first one is income, that should be positive. Time interval of the income received and general price level, nature of the unexpected emergency. So that can be also negative. So therefore it could be said that higher the rate of interest, the lower will be the demand for money and vice versa. Here when the interest rate is at its lowest, speculative demand for money will be infinite. At this level, there will be a liquidity trap. So the government cannot use monetary policy through reducing interest rate to stimulate AD. Relationship between interest rate and price of bonds. So there is an inverse relationship between interest rate and price of bonds. If interest rate rises, the price of bonds will fall and vice versa. So if the interest rate is low at present, price of bonds will be high now, but people will expect the future interest rate to rise and price of bonds to fall in future. Thus, in order to buy bonds at lower prices in the future, people will hold more money with them. So that's it for now. So this was the beginning of money and banking. Thank you.